Hello, everyone. Today on the final bar, I'm joined by Clif Droke from the Cabot Wealth Network. He's going to talk to us about the commodity space a little bit. Overall, happy Fed Day. We have plenty of movement. At the end of the day, the S&P directionally not really making much progress in either direction, settling in around 4,400. Other key thing to describe this week in the markets are all the impacts of earnings, specifically the FAANG stocks. We'll spend a little time looking at some of the announcements and what the charts are looking like before and after those announcements. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets through the lens of technical analysis, behavioral finance, investor psychology. We focus on the message that the charts can provide about investor decisions, fear, greed, supply, demand, most importantly, the emotional state of investors as they react and overreact to all the information out there. Today's Fed Day. We had the Fed meeting over the last 2 days, minutes released this afternoon, press conference, and so forth. Overall, sort of a non-event when you look at the impact of what was discussed. No huge change in Fed policy. No real indication that there's anything more than talking about making changes. A little later in today's show, we have a segment, Don't Fight the Fed. We're reviewing a little more detail the reaction of some of the markets afterwards, what that might mean for the big picture. And also a great guest today in Clif Droke. Let's get to our schedule coming up. As mentioned, talking to Clif Droke a little later in today's show. Tomorrow on the 29th, we have technical analyst Bruce Powers joining the show again. Next week, a couple great guests for you. On August 3rd, Andrew Thrasher from Thrasher Analytics, Mark Chaikin, creator of Chaikin Money Flow and many other indicators that you probably use, joining us on August 5th. And then coming up on August 10th, Gary Dean from SentimentTiming.com. Continuing on with our market recap. So the market, as we've mentioned previously or earlier this week, there's no shortage of potential catalysts for the market to move. There's a lot happening between the Fed, between earnings, a lot of potential things to happen. You know, if I would summarize the market today, indecision might be the way I would describe it. You had plenty of volatility today. You had the S&P opening on a little bit of weakness, trading above the zero line, trading back below the zero line after lunch, trading back above in the afternoon, and then finishing off right where it started. So literally, we have set an equilibrium price, and it's around 4,400. So, you know, the fact that the Fed announcement was in the middle of that, and while you certainly had some movement, and the S&P went up after the minutes were released from there, you know, really coming right back down and giving back a lot of those gains that were registered. So overall, the NASDAQ outperforming today with the NASDAQ 100 up 0.4%, the NASDAQ composite up 0.7%. It's really driven by communication services. We have some of the FAANG stocks reporting. We have Facebook after the close as we're recording the show today. Obviously, yesterday we had Alphabet, which had a pretty good win on the earnings side. We'll look at those charts here in a moment. Mid caps and small caps outperforming the S&P. So while the S&P was flat, the small cap index was the number one of the group. Very quickly on other asset classes, 10-year yields back higher today. We talked about the overall interest rate environment and what that most likely means. Higher rates in general tends to be better for something like financials, tends to be less ideal for a growthy sector like technology. However, both of them today sort of in lockstep. Tech and financials both down just a token amount off the zero line, even though interest rates coming up a little bit. 10-year yields around 126. The dollar index down about 0.25% using the UUP. But again, the dollar really hasn't been moving directionally very much. It's been fairly choppy to sideways recently. One of the big movers after the Fed meeting was the price of gold. The GLD finished up about 0.5%. Around 2 p.m. Eastern, it was down on the day, retesting the lows after the open, but rallying and finishing in a position of strength. So interesting how that may impact the long-term chart. We'll look at that here momentarily. Oil prices up as well, and energy was the number one sector. Cryptocurrencies, very choppy day overall, directionally, not a big amount of movement with Bitcoin currently up 2% from where it was yesterday. Big move higher, obviously, in some of the cryptos, including Bitcoin. So not much of a follow-through day today. Let's look at a chart of the S&P 500. We'll look at some of the other themes to wrap up this market recap. Looking at a daily chart of the S&P, again, not much change today. It's interesting, on a Fed day, we have what's called a doji candle. A doji candle, again, if you know your candlestick analysis, that's where the open and the close are about at the same level. And what that represents is indecision, right? You have a move, you open at a certain point, instead of closing far above or far below the open, indicating some intraday bias where traders, buyers or sellers are taking control. Here, you move around, but at the end of the day, you really haven't gone anywhere. That tends to be a sign of reversal, right? An indecision usually means the end of a move, and it's a reversal signal using candlestick charting. Last time we had a doji candle on the S&P itself was the first week in July, by the way. You had a bit of a gap down, tested the trend line, and bounced back up. So, but again, we've been choppy for the last couple of days, so I don't know if this directionally tells me much of anything besides the market is experiencing indecision, which I think we've known for quite a while. What is more interesting to me, and I hesitate to annotate the chart live here on the show, but I'm doing it anyways. If we look at the S&P recently, I'm going to do a similar line to what we've done previously. We're getting a potential bearish divergence here, and we've had a couple of those so far year to date. We had one here in January, the market moving to new highs on lower momentum. That resulted in a 4.8% pullback soon after. And again, a little bit more in February, but that was the initial pullback after that bearish divergence. Here in April, we had it again. It was only about a 4.25% move from intraday high to intraday low. Potentially, we're seeing that same thing, and that depends on what happens through the remainder of this week. If we continue to distribute a little bit, which just makes this a clear higher high, relative to the ones early in July, I think you could call that a legitimate bearish divergence. And so I think that's maybe still a question mark, but I'm putting it on as a reminder to focus on that potential bearish divergence. 4 to 5% pullback would take us right down to, you guessed it, the 50-day moving average, which is where the previous pullbacks have ended, right? After these previous bearish divergences, pulled back to the 50-day moving average, have bounced soon after. That measures about the same to what we have seen before. So I think if we do see a pullback of sorts, the 50-day, the previous swing low around 42.50, those would be the first sort of lines in the sand indicating a potential support level. If we hold that, then that is a very plain vanilla standard 2021 kind of pullback event. If we would break below that, all eyes on 40.50, which would be a much deeper pullback now that we've gotten a little further off of that level as we continue to make new highs. But remaining above there, I think overall would keep this general bullish structure in place. Those are some of the levels I would pay attention to. I mentioned very quickly the price of gold, and I want to ask my guest today, Clif Droke, who knows the gold space probably much better than I do, for his take on what's happening. But I have to note something that certainly had a reaction to after the Fed meeting. What's interesting on the chart of gold, still we're sort of where we were about a week and a half ago, right? The gold price sort of bottomed out here in June, lower lows in the GLD, higher lows in momentum. We saw the nice bounce higher, but then we kind of hit these moving averages and have bounced back lower. Now we're sort of in this range with sort of 170, 172 on the upper end, which are moving averages, previous resistance, etc. On the downside, we have 164 to 165. Those are the swing lows from before. And I think keying in on some of those levels is a Fibonacci level, by the way, at 172 as well. So we're sort of in that range bound scenario. We have clear resistance and clear support. The question is, which side takes control, and where are we able to see follow through momentum that propels us through resistance or through support? And I would argue, I think that's the direction of that next move should most likely indicate the future direction. That's going to be the indication of which side of the coin is in control and where we might see a move to next. Just to wrap up our recap very quickly, as I mentioned, energy stocks up the most today with the XLE up 0.9%, followed by communication services up about 0.8%. Let's go to the Google here very quickly. When we look at the chart of Alphabet, I think if there's a concern, again, I'm very good at picking out potential concerning items as we go to new highs. I'm fantastic at that, and it has been something I've enjoyed doing all along this uptrend, pointing out what could be a problem. And I think that's, again, I think looking at any trend with a good dose of skepticism is a good thing. It helps you consider alternatives, consider what a negative, a reversal may look like, and just so you're prepared for, you've thought through that scenario. So the chart of Alphabet, what concerns me on the charts of Apple and Alphabet and others, pretty decent earnings this quarter, pretty decent reports, plenty of evidence in there, arguably to support prices going higher from here. I don't know if necessarily all of that was priced in. However, the fact that the market's not really, a chart like Alphabet really isn't following through at all to the upside suggests one of two things, potentially. Number one, all of that excitement has already been priced into the stock. And the fact that these things are so overbought, so overextended, have been outperforming so consistently, that is a very decent argument that sort of earnings report has already been priced in. There's been a run up leading into earnings, and as a result, there's nothing left to push the stock higher. The other thing is that there are concerns below the hood that aren't really clear on an earnings release, right? It's something outside of that. It's a general rotation from risk on to risk off. But again, when I see a company that has good earnings and the stock does not bounce higher immediately and clearly recognize that investors are interpreting that earnings beat as a sign of much further upside, that's where I start to get a little concerned on the bullish side, because there's not the follow through from what could be or what should be a potential catalyst for the market to go higher. We need to take a quick commercial break. We'll be back with my guest, Clif Droke. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for our show. We appreciate you joining us. Two quick announcements before we get to my guest, Clif Droke. Number one, I want to remind you, we are here to answer your questions at all times. We do a mailbag segment twice a week. We'll do our next one on Friday's show, and we would love to answer one of your questions on the air. Anything is fair game. Questions about technical indicators, about stock charts, about particular charts that you're working through, anything is fair. Shoot us an email with all of your questions. The final bar at stockcharts.com is the best way to get a hold of us. We are also on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching. We'll gather all those questions and hope to answer one of yours in our next mailbag segment on Friday's show. Also, please go to StockChartsTV.com. Use your email address, set up a free account. You can start watching all of our fantastic content from all of your mobile devices. Great shows like The Final Bar and The Pitch and others. Special events like our recent Charting the Second Half, mid-year market outlook. Great guests like Clif Droke and many others. All on StockCharts TV on demand. Go to StockChartsTV.com or just search on your mobile device on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Clif Droke. Clif is with the Cabot Wealth Network. Recently, just unleashed a new newsletter, the SX Golden Metals Advisory. Clif, it's a pleasure to have you back on the show. Thanks for joining us.
Thanks for having me on, Dave. Always enjoy it.
Yeah, I appreciate you coming on. I want to get to gold and precious metals. It's obviously a bit of a bounce here this afternoon, but first, starting a discussion about breadth. I mean, one of the questions on a lot of people's minds are just the general breadth conditions as the S&P and the NASDAQ for sure have continued to go higher and higher. Start us here. Talk us through what you're seeing.
Sure, Dave. I think this kind of ties into what I'm going to say about gold, but like you say, breadth has been a major concern this summer. My favorite breadth indicator are the new 52-week highs and lows. To me, they show the incremental demand for equities, and what we're seeing in the NASDAQ is well above normal new 52-week lows. This has been a continued problem for months. Here recently, we're seeing in July triple-digit new lows, which is not a good sign. Most of the selling, of course, being in the pharmaceuticals industry, but nonetheless, there is a major undercurrent of weakness in the market. I'm not predicting any kind of imminent sell-off in equities. I just wanted to bring attention to that because usually when you've got this much consistent internal selling, it means smart investors are getting nervous and they're raising cash. And the question is, where are they putting that cash? And I've got some speculations as to where they're putting it, but it's important to realize there's an undercurrent of weakness in the equity market. And sooner or later, I think that will come to the fore.
Very interesting. Chart number 2 is a ratio of the gold index, $GOLD, to the 10-year yield, $TNX. Talk us through this one.
Sure. This is one of my favorite ratio charts or indicators for gold, because one of gold's leading indicators is its relationship with 10-year treasury yields. Gold, of course, bullion doesn't yield, and it competes with bonds for safe haven investments. So when gold is outperforming 10-year yields, like it's outperforming TNX right now, it's usually a sign that there is some accumulation taking place in gold. And you can see that sort of a gentle upward slope since April and accelerating since late June. You mentioned that the gold bottom, the price low in gold, was in June. And it's interesting that that is exactly the time when the New York Times coronavirus case rate tracker started turning up. And I think what's happening is investors are beginning to fear what the possible restrictions arising from the so-called Delta variant of that virus. And as we head closer to fall, a lot of investors are anticipating more restrictions. And the question is, what impact might that have on the economy? I think that is what is fueling gold right now, is the fear of this Delta variant. So you can see the correlations between the cases and the gold price to some extent.
It's a great chart. It's an interesting ratio to look at. And I would not disagree with you, Cliff, at any point that I think fear dominates the market at all times at this point. The question is, when people are fearful, where do they end up going to? When you're thinking about the overall market environment, you mentioned the NASDAQ and an increase in new lows over the last month or so. You have a situation where the S&P continues to make new highs, but during this period of uncertainty, which you imply with unknown with the coronavirus and everything, given that sort of general backdrop, where do you look for opportunities here? Is it in things like precious metals that could be a potential safe haven? Is it more some of the FAANG stocks that have had pretty good runs, but so far have demonstrated their ability to outperform? Where are you looking opportunistically now?
Well, I suspect there will be some continued near-term outperformance in the FAANG stocks.
Yeah.
But I'm looking mainly at defensive areas of the market, gold being one of them. I'm also looking at consumer staples and utilities, which I also believe will begin to outperform as we head closer to fall. So to me, I see evidence that smart money is beginning to move slowly into defensive areas, but I think the FAANG stocks can continue to outperform this summer.
You mentioned, Cliff, we only have about 30 seconds left, but you mentioned again, the breadth conditions, which have become, less and less optimistic, which is totally fair. When you're thinking about this potential, just beginnings of a defensive rotation, is there a line in the sand? Is there a level on something like the S&P or the NASDAQ that would convince you, okay, this is it, we're rotating lower, now's the time to, get really defensive? Or is it more breadth conditions deteriorating? Is it a change? What signal would you be looking for to confirm that a new downtrend is starting to really develop?
Well, certainly, as you pointed out, a decisive weekly close below the 50-day line would be a heads up. But mainly, I would just look at continued deterioration in breadth, primarily the 52-week highs and lows. If they keep shrinking and the lows keep growing, that's not a good sign.
Well said, Cliff. I will have to leave it there. Listen, thank you so much for coming on. Appreciate you sharing some of the charts with us, reinforcing the importance of breadth. But hope you stay safe, be well, and we'll talk to you again soon.
Thank you, Dave.
That's Clif Droke. Cliff is with the Cabot Wealth Network, coming to us from North Carolina. And again, just released a new newsletter called the SX Golden Metals Advisory. It's a great take. And again, we've talked about new highs and new lows at times, but not super often. What I love about this chart, by the way, that he shared is, when I look at new lows, it's usually with new highs on there. And there are so many new highs, it sort of dwarfs the number of new lows. So I feel like as he's showing this chart, I'm like, man, I really need to think of looking at them separately to really see how, just the number of stocks that are really out there. It's sort of a rounding error compared to the stocks making new highs for most indexes. But boy, there may be a signal there that I've been missing just by, looking at the chart a certain way. I love when a guest comes on and I'm able to make some notes about a new chart or a new way to think about a particular take. So a great discussion there with Clif Droke. Let's continue on with our next segment. Don't fight the Fed. So, as we've talked about, and I just want to spend a few moments talking about just the Fed overall. So, when you look at the Fed this year, I would argue one of the main challenges that I think investors are going to be grappling with and have been for quite a while and will continue to is the Fed and their need at some point to change policy, right? At some point, I think it's undeniable that they have to change from a super dovish policy structure, which is essentially doing whatever they can to continue to support asset prices, risk on assets like equities and others, and at some point start to address inflationary pressures and address the fact that there's a need to temper that a little bit and start to have what's called a more hawkish tone, which is less supportive and starting to allow rates to go higher and so forth. What happened today was very little of that. What I mentioned earlier in the week is on Wednesday we have the Fed. This could be an opportunity for them to set the stage for a change, right? I mean, the challenge, the dance that has to be made between now and any actual change in interest rate policy is the PR experience of making that, minimizing the impact or the negative impact on stocks. And the moment the Fed says they're going to be less supportive or less, continuing with their asset purchasing program, the chances that the market's going to react negatively are certainly very, very real. And today could have been an opportunity. I could have seen the argument for getting away from talking about a change in policy and actually talking about it, actually starting to put a timeline in place, or at least hint at that. And I saw very little of that. I'm going to dig a little more into all the details I can on the Fed meeting, but my initial reaction is we got very little. Obviously, no change in interest rate policy, but no real implication that anything changing. Still, inflation is transitory, not anything to worry about. There's nothing to see here. Let's continue on and keep things going as they are. So what that does not do is I would argue if they had started to be a little less dovish, a little less supportive, you could see where the market react very negatively to that, because it makes a very real, it starts to begin a timeline of changing. We don't really get that, which means that pushes it a little further here into the summer, into the fall. And again, this is an issue that at some point the can can't be kicked any further down the road, and it most likely is going to happen. It's not going to happen today. So what happened, as a result of that? So in general, the market holding up just fine. Again, a doji candle today, but not a huge, difference from yesterday. If you look at the movement in the S&P, a rally sort of right after, but gave all of that back. Now, again, what you also have to remember, and I think it's important on a Fed day like this, there have been times in market history where the Fed meeting is the story, and that's it. All you need to know is pay attention to the Fed, think about what is being priced in, think about what might happen afterwards, and place your bets accordingly. Here, however, it is one of many things. It is a noisy market right now in terms of the potential catalyst. You have the Fed number one. We have the coronavirus and the uncertainty of that, as my guest Clif Droke was mentioning. Certainly, that is a huge unknown. We don't know what's going to happen in the coming weeks and months, and what impact that could have on asset prices. We also have heavy earnings right now, and the question is how much is priced in already? How much is yet to be priced in? Are there any surprises? We have a Robinhood IPO at some point this week beginning to trade, which will certainly reignite a lot of discussion about Robinhood and brokerages and their business models and et cetera, et cetera, et cetera. So I think the challenge right now, or I guess the real takeaway from me, is the fact that the Fed had their meeting. I would say no real change to it. I would be thinking about the Jackson Hole Jackson Hole meeting, and then future Fed meetings during the year. And at some point, the discussion has to start to address the need to change Fed policy, and we're not there yet. Just with the time we have left in this particular segment, I just want to focus on some of the FAANG stocks that have reported, because there's been a heavy earnings week. We're going to have a segment tomorrow focused on earnings called The Bottom Line, where we'll spend a little more time on a lot of stocks because there's so many that are happening right now. But let's talk about the four FAANG stocks that are sort of at us right now. So yesterday we had three of the four reporting after the close. We had Alphabet number one, and again, all of these for the most part have had pretty decent earnings reports. Alphabet actually trading down today, closing down about 1/3%. We have Microsoft today, and again with a pretty decent report after the close yesterday, down 0.1%. That's after a closing below the open yesterday as well. Finally, we had Apple, and out of the three, this is the one that's come off the most, down about 1.2% today. So the FAANG stocks, which have had good runs, potentially having priced in all of that ahead of time, or just there's not enough in the earnings to ignite a renewed spirit of interest in those stocks. Now, Facebook is a bit of an outlier because it's actually been trading higher. It's up 1.5% today. And out of all of those FAANG stocks, has had maybe potentially the best run, recent bounce off the 50-day moving average, relative strength making a new high. What we'll do here is go to the symbol summary tab. And as a reminder, on StockCharts, we have after hours data on equities and ETFs. Go to the symbol summary page. You can either at the top of the screen change sharp charts where it says symbol summary, or further down below the chart, the sharp chart that you're looking at, there's a little link to the symbol summary, which is what I just clicked on. So after the close, and I have not looked at Facebook's earnings, I've been busy looking at all these other beautiful charts we've been referring to. I'll dig into it a little later, but so far after the close, Facebook actually down 3.5% to 3.6. I didn't look at some of the other stocks to see where they're at, but that sell-off puts Facebook actually right to this breakout level, which is a really interesting place for Facebook to open tomorrow, if that's about where it begins. We'll see how the rest of the after-hours session goes. We'll see what happens before the market tomorrow, with plenty more earnings releases, a number of mega cap stocks as well. But Facebook at 360 would put it right at that breakout level. And what's interesting on a lot of those charts, Amazon, Alphabet, others, you've had this range, you've had this resistance level, this base, and then breaking above it. Amazon has already tested that from above. And the question is, does Facebook sort of have that same look of a potential failed breakout, right? A break to new highs, which in a normal environment would seem very, very encouraging. Something like that, all of a sudden trading lower would be a bit of a concern. This is what I'm talking about with Amazon, right? Amazon looks kind of like Facebook right about here. And then you can see what happened there is we actually pulled back and tested that breakout level. Now it's sort of in a no man's land. And the question is whether it comes back down into that basing range again. We need to wrap this show, folks. Go to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number 1 is the CQQQ. A lot of discussion recently, obviously, about China. And again, we had this whole show where I talked about all these huge catalysts. I didn't even address China's and the Chinese government with regulatory implications of changing and they're affecting a lot of the stocks trading there. A lot of the Chinese market down recently, given the prospect of further regulatory pressure by the government. You can see on the CQQQ, which is one of the tech ETFs, there are a couple others like KWeb and one other whose ticker escapes me, but CQQQ is a proxy I tend to use for sort of the Chinese technology trade. This is actually a beautiful masterclass in Fibonacci retracements. If you take the low from March of 2020, take the high from February of 2021, look at it as literally most moves have been bounces off of the 38.2, 50%, or now the 61.8% moves. One that was not mentioned was the 200-day moving average, which is where it bounced off in March. What's happened is this ETF has already come down a great deal from almost 110 to around 67. So it's down about 30 to 40% already. But now it's oversold, oversold, similar to where it was, bouncing off previous Fibonacci support levels. So it's at a Fibonacci support level. It's oversold in previous times when that's happened. You've seen at the very least a nice bounce. So not surprising to see the bounce today. And the question is this distribution, is this this anxiety, this potential headwind of regulatory pressures, has enough of that been priced in that all of a sudden these are stocks at a deep discount and at a good viable point? So far, the bounce is suggesting that may be the case, but that support level would be key from yesterday. Chart number 2, just highlighting some divergences. I think my guest Clif Droke mentioned the breadth divergences very well. This is a chart that comes to mind for me. Here's the S&P 500 with a higher close this week. Here's the lower movement in the advanced decline line. Here is the lower movement in RSI. So we have breadth divergences. We have potential momentum divergences. The McClellan Summation Index, which we highlighted yesterday, trending downwards as well. Finally, public service announcement. There are always stocks making new all-time highs, regardless of the environment. Today's example, Amphenol, APH, which is the electrical components group within technology, potentially breaking out of a 6-month base here. 6-month base, making a new all-time high today. The question is, with these names, can they hold the 50-day moving average on any pullback? Folks, that is our show for today. Special thank you to Clif Droke, joining us from North Carolina. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.